Today's highlights: Bitcoin is still at the bottom, Ethereum's supply is tightening as demand warms up, and chips are slowly changing hands. With MicroStrategy's $42 billion buying spree and Wall Street's massive positions, is the crypto market facing a major shift? Tuesday, March 24th. Welcome to BitcoinTV's Chinese channel. Where is the chain? I'm Dong Dong. Let's look at the top crypto data from the last 24 hours. Don't think Bitcoin is high yet. On-chain valuation shows it's still near the floor. The DTMM is only 1.68. This index essentially measures how far the price is from institutional and minor costs. Historically, 1.5 is the bottom, 2.5 is the takeoff point, and 3.5 is considered expensive. Right now, it's only 68% above its base value, not even at the midpoint. Meanwhile, the network's total base value is around $819 billion. Looking at the price structure is even more interesting. Support levels are holding at $70,000, $65,000, and $60,000. The bottom at $54,358 is still near the cost line. Simply put, it's not that it's risen too much, but that it hasn't reached the expensive zone yet. The market is mostly accumulating at low levels. If you're only watching Ethereum's price, you're already behind. The real changes aren't on the charts, but on the chain. Exchange inventory has dropped to 16.2 million, the lowest since 2016. Meanwhile, 37 million are locked in staking, so circulating supply is shrinking. On the other hand, active addresses are rising, meaning people are using it again. Plus, EIP4844 lowered Layer 2 costs, making transactions cheaper and bringing users back. Also, after a round of deleveraging in the futures market, it's slowly recovering. The structure is healthier now. To put it simply, this isn't just a simple rebound. Supply is tightening, demand is recovering, and the market is quietly shifting. You might think it's just sideways movement, but chips are being moved behind the scenes. In the last 48 hours, nearly 20,000 bitcoins were withdrawn from exchanges. 11,112 plus 8,427 is no small amount. Inventory fell from 2.76 million to 2.7 million, a drop of 57,500 in 13 days. Available coins are becoming scarce. Meanwhile, the SOP shot up to 1.94. This shows some are taking profits as prices nearly double. However, the MVRV is only 1.25, far from overvalued. Essentially, while some are cashing out, others are buying and locking in at low levels. The price seems stagnant, but chips are quietly changing hands. This kind of structure often leads to a sudden market shift. Please like and hit the bell. We monitor news 24/7. Our channel takes a macro view, using 15-minute deep dives to help you master major changes in digital assets and boost your knowledge. Now, let's get to today's news. Think companies buy Bitcoin based on market swings? Wrong. The game has evolved. It's now an unstoppable cycle of auto-printing cash to auto-buy coins. Strategy's latest move is simple. They've turned the traditional capital market into a literal ATM for Bitcoin. Stock price up, issue shares. Markets buying, issue more. Use that cash for Bitcoin. Bitcoin rises, boosting the stock, so they issue more shares. It's a self-sustaining loop. It sounds simple, but they've scaled it to $42 billion. This isn't just a fundraise. It's a permanent, long-term Bitcoin buying engine. So the question isn't if Bitcoin will keep rising, but if this model persists, then the demand for Bitcoin will no longer be just about retail and ETFs. Continuous corporate accumulation will be the real game changer.
Strategy filed on March 23rd to launch a $42 billion ATM financing plan with $21 billion in common stock and $21 billion in preferred stock. This allows the company to raise funds in stages and buy Bitcoin. The company now holds about 760,000 BTC with a total investment of $57.6 billion and an average price of $75,000.
They give someone in Japan or Europe or Switzerland or New York City a bank account to pay them 10% with no volatility. And if you think that Bitcoin can power that, then you're buying our stock because we're a digital credit factory.
Affected by Bitcoin's volatility, Strategy's stock price saw a pullback, dropping between 1% and 2% in a single day. The stock is highly correlated with Bitcoin. The market views this as a leveraged Bitcoin asset with volatility significantly higher than spot Bitcoin.
You think the company's buying Bitcoin? Actually, the market is buying it for them. Normally, a company raises funds for operations or expansion, but Strategy does the opposite. They raise money to buy Bitcoin, then use that Bitcoin to boost their valuation. It's a very clever loop. As long as the market gives them a high valuation, they can keep issuing stock, keep buying coins, and push that valuation even higher. This means Bitcoin's price isn't just set by trading anymore. A company's ability to raise capital is now influencing the price too. The real thing to watch now isn't whether they'll buy, but whether the market will keep giving them the money to do it. I think once this cycle is proven, Bitcoin gains a nearly automated long-term buyer. It's not about speculation, it's about the mechanism. Think companies buying Ethereum are just betting on the price. Wrong again. The new game is making money work for itself. Bitmain's recent accumulation looks like simple hoarding, but they're actually building an on-chain yield system. Before, companies held Bitcoin like digital gold, just waiting for it to go up. But Ethereum is different. It can be staked to generate steady returns. Benefiting from volatility while collecting cash, it's the best of both worlds. Simply put, this is no longer just about buying coins, but moving the balance sheet directly onto the chain. Whoever masters this logic first will redefine how companies allocate crypto assets.
According to Block Temple, Bitmain's latest disclosure shows its Ethereum holdings have reached about 4.6 million tokens, with total assets exceeding $11 billion. This accounts for approximately 3.8% of the total Ethereum supply. And they continue to expand their holdings, showing that institutional capital is strengthening its long-term allocation to Ethereum.
Wall Street now is going to be building its entire infrastructure onto the blockchain. And the blockchain they're choosing is Ethereum. So this is the 1971 moment where Wall Street is essentially capitalizing on tokenizing the entire world onto a blockchain. That's a huge opportunity.
Currently, about 3.14 million of Bitmain's Ethereum tokens are staked, representing about 67% of its holdings. Based on the current annual yield of 2 to 3%, the annual income could reach hundreds of millions of dollars. Meanwhile, the company is advancing its validator network to optimize its yield structure. This shows Ethereum is shifting from a price-only asset to a yield-bearing on-chain asset.
Looking deeper, the competition between companies is no longer about who buys more, but who can turn an ETF into a money-making asset. In the past, hoarding coins was about whether the price would rise. Now it's about yield stability and structure. Ethereum allows companies, for the first time, to do two things at once: benefit from price elasticity while capturing on-chain cash flow. It's like merging assets and yields from traditional finance into one. The real change ahead isn't how much Ethereum will rise, but how many companies will start restructuring their financial models this way. Once this model is proven, corporate crypto allocation will no longer be about gambling on direction, but about competing on capability. US regulation has cut off the path to easy money. The 3.5% yield is gone, and 25,000 contracts are void. Institutional leverage is driving Bitcoin wild. You think stablecoins are just digital dollars you can hold for steady interest? Wrong. US regulators have flipped the table. The sharpest cut of the Clarity Act isn't on trading or issuance, but on yield itself. In short, the days of earning passive interest just by holding stablecoins are likely over. Because this hits the core of banking: deposits. Simply put, stablecoin yield isn't a technical issue, but a question of financial power. That's why banks, exchanges, and policymakers are in a direct head-on collision now that this bill has been introduced.
The Draft Clarity Act proposes prohibiting institutions from paying interest or yields to users solely for holding stablecoin balances. This primarily targets stablecoin yield products on exchanges and platforms, while still allowing incentives based on transactions, payments, and liquidity. The key is to distinguish passive income from usage incentives.
We've created a USD coin, which is the second largest stablecoin out there. As you mentioned, interest rates in this environment, that's been both a good source of revenue for us, but it's also something that we've passed along to customers. So customers can actually earn rewards on USDC and get access to some of these higher interest rate environments.
The core of the regulatory push for this restriction lies in the risk of capital outflow. Relevant analysis shows that if the stablecoin yield mechanism continues, it could impact trillions of dollars in bank deposits. Meanwhile, stablecoin yields on some platforms range from about 3 to 5%, higher than traditional savings rates. This interest rate gap is believed to be weakening the funding base of the banking system.
If you break this down, it becomes clear. This isn't about regulating stablecoins. It's about regulating where the money flows. In the past, users kept their money in banks. Now they're switching to stablecoins for the yield. Simply put, they're competing with banks for deposits. If this trend continues to grow, the very foundations of traditional finance will be shaken. So, what regulators are doing now can be summed up in one sentence: they're blocking the path to easy, passive income. In the future, if you want to earn a yield, fine. Go trade, go use it, go participate. Don't just sit there. To put it plainly, stablecoins won't disappear, but they will be redefined. They'll shift from being yield tools to payment tools. The real variable isn't whether stablecoins can still make money, but who can generate yield under the new rules. You think Bitcoin ETFs are just about buying spot? Wrong again. What really sets the market pace are the derivatives behind them. The New York Stock Exchange did something very critical this time. They directly removed the safety valve that originally restricted position sizes. On the surface, it's a rule adjustment, but in essence, it opens up much more room for institutions to operate. Previously, when big capital came in, it was capped by the 25,000 contract limit. Now that ceiling is gone, which is like taking the gloves off. If you ask me, this isn't about loosening regulation. It's about elevating Bitcoin ETFs to the same derivative class as gold and crude oil. The coming market volatility might not be from new money coming in, but from leverage being amplified.
According to Blocktempo, NYSE Arca and NYSE American have adjusted the position limits for several Bitcoin and Ethereum ETF options. The original limit of about 25,000 contracts has been relaxed. This rule was initially established when options launched in 2024 to prevent manipulation and excessive volatility. These adjustments are currently moving through the implementation process. This involves major ETF products such as IBIT, FBTC, and ARKB.
Is taking that ethos of what has happened over the last 10 years. We believe ETFs is the technology that's going to transform every asset class. We believe everything will be done through ETFs.
Following the relaxation of limits, these ETF options will gradually follow commodity ETF standards and support flex option trading. This allows for customizable strike prices and expiration structures, enhancing flexibility for large trades and hedging while helping to boost market liquidity. Additionally, Nasdaq has proposed raising the IBIT position limit to 1 million contracts.
Looking deeper, this isn't just about easing limits, it's about amplifying leverage. ETFs solve the issue of accessibility, but options solve the issue of amplification. Once position limits are lifted, the market structure changes. Prices aren't just driven by spot capital, but by derivatives amplifying volatility. In other words, Bitcoin is evolving from an asset into a tradable tool that institutions can deeply manipulate. So, the real thing to watch next isn't ETF inflows, but whether derivatives are starting to amplify trends. Once this mechanism is in motion, Bitcoin's market rhythm will increasingly resemble traditional commodity markets.
CoinShares has filed for a Bitcoin volatility ETF under the ticker CBMX. This type of product doesn't bet on price direction. It profits solely from volatility. Simply put, institutions have begun using Bitcoin to trade on market sentiment. The computing power leasing sector rebounded, with Meili Cloud hitting its daily limit and others following. Meanwhile, China's average daily token calls soared from 100 billion in 2024 to 100 trillion in 2025. This March, it surpassed 140 trillion, a thousand-fold increase in 2 years. To put it plainly, the demand for AI computing power has begun to explode. A Hong Kong woman was scammed out of over 5.5 million Hong Kong dollars in 2 months. Police received 15 similar cases in 1 week involving nearly 10 million Hong Kong dollars. Basically, combining romance with crypto investing is becoming the most ruthless scamming tactic. Alibaba International has launched the enterprise-level agent Axio Work, which is ready to use without deployment, focusing on e-commerce and business decision-making, and is open to the global market. In short, AI agents are evolving from mere tools into employees who do the actual work. A fund under Mutai has taken a stake in Jishin Technology. Its registered capital rose from 21.9 million to 25 million yuan. Founded in 2023, the company focuses on intelligent robots and AI software. Simply put, the liquor giant is also starting to bet on the AI hardware sector.
With this AI wave, many still view it as just a tool for writing drafts or creating images and videos. But this 2026 cycle is clearly different. From OpenAI to AI agents, the real change isn't in efficiency, but in the mode of production. You'll see some still doing everything themselves while others command AI. One person plus AI can do a team's work. The gap isn't in knowing how to use AI, but in having the courage to delegate work to it. In short, the future isn't about how hard you work, but how well you mobilize resources. Remember, AI isn't a replacement for humans. It's an amplifier of human capability. All right, that's all for today. Our channel focuses on core narratives and value discovery in digital assets. If you agree with our logic, feel free to share and follow us. You can also stay updated with the latest news by turning on real-time notifications. To access a higher level of research reports, you can follow our advanced channel. From Monday to Friday, I'll share my personal deep market reviews to capture certain opportunities within the trends. See you tomorrow.